Silver under 80 isn't the story. The story is how quickly the market can turn your confidence into confusion. Silver is that wild animal that looks calm until you step too close, and then it reminds you it was never domesticated. What you're seeing is not just a price story, it's a structure story, and structure decides who survives the path. Quick check-in. Comment one word: stack. If you mostly buy physical, trade if you mostly use paper exposure. Then we move. A volatility loop is not just a fancy way of saying the price is swinging. A volatility loop is when the swings feed themselves. The move creates attention. Attention creates positioning. Positioning creates fragility. Fragility creates forced trades. Forced trades create bigger moves. And bigger moves create even more attention. It's feedback. It's reflex. It's the market turning human psychology into a mechanical process. And once the loop starts, the tape can punish both sides. It can squeeze you up and it can liquidate you down, sometimes close enough together to make you question reality. Silver lives in two worlds at the same time. The physical world is bars, coins, fabrication, shipping, premiums, delivery times, and the boring reality of inventory bottlenecks. The paper world is futures, options, leveraged exposure, and claims that can expand or contract faster than metal can be mined, refined, or delivered. The screen price most people watch is heavily shaped by the paper world in the short term, especially when volatility rises. That's why you can see spot drop while physical premiums hold firm. That's why you can see spot spike while dealers widen spreads and delay shipping. It's not magic, it's two separate arenas reacting to different constraints. Round numbers like 80 are psychological magnets. They attract orders and they attract narratives. Humans anchor to clean numbers, so stops cluster around them, take profit orders cluster around them, and buy the dip hopes cluster around them. That clustering matters because clustered orders create liquidity pockets. If price slips into a pocket where stops sit, a normal push can become a cascade. If buyers are waiting at a pocket, a normal dip can bounce violently. So don't worship the number. Watch how price behaves around it, because behavior tells you where the fragility is. Retail flow matters in silver, not because retail always has the biggest wallet, but because retail changes the story. Retail turns a commodity into a social object. People post receipts. People compare stacks. People talk about shortages and delivery times. That public attention acts like an amplifier. In a deep market, an amplifier is just noise. In a thinner market like silver, an amplifier can move behavior. And behavior is where the real fuel lives. The money that matters most is often the marginal money, the money that shows up at the edge and changes what other participants feel comfortable doing. Here's the uncomfortable truth. Retail waves don't usually produce straight lines. They produce pulses. A burst of buying, then cooling, then another burst when the story returns. The tape spikes to make you chase, dumps to make you regret, grinds to make you bored, and then spikes again. That pattern is not random. It's what happens when different time horizons collide. Long-term buyers accumulate. Short-term traders chase. Leverage participants get forced. Then the tape resets and the cycle repeats. The most important sentence you can learn in this environment is simple. The market doesn't have to beat your thesis. It only has to beat your margin. If you're using leverage in a loop regime, you're not trading direction alone. You're trading the rules. When volatility spikes, exchanges and brokers protect the system. They raise margin requirements, widen haircuts, tighten leverage, and reduce the room you have to breathe. If you can't post extra collateral, you are sold out of your position. Not because you were morally wrong, because you were structurally fragile. When retail flow is real, you usually see it in the places that don't show up on the main price chart. You see it in premiums staying firm even on red days. You see it in popular products selling out quickly after rallies. You see it in delivery windows stretching. You see it in dealers widening spreads because they don't want to be the last person holding inventory when the paper price whips. That's not conspiracy. It's logistics meeting emotion. And in silver, logistics plus emotion can run faster than rational commentary. The paper market is where loops turn dangerous because paper can be crowded with leverage. When leverage is crowded, small moves trigger big reactions. Stops trigger. Margin calls trigger. Risk models tighten. Spreads widen. Market makers step back. Liquidity thins. And then price moves farther than anyone thought was reasonable. That's why you can have a day where the chart looks like a slot machine. It's not magic. It's the plumbing of derivatives in a market that isn't as deep as people assume. If you want to know whether a new loop is forming, stop asking why in the emotional sense, and start asking who is forced. Forced sellers sell into weakness. Forced buyers cover into strength. Both accelerate moves. So the questions that matter are measurable. Are rebounds holding for a full session, or getting sold within hours? Are we seeing follow-through after sharp down days, or does selling exhaust quickly? Is volatility rising as price falls, or is volatility compressing as price stabilizes? Are physical premiums moving differently than spot? Those signals tell you whether the loop is tightening. Physical holders and paper traders experience the same market differently. If you are stacking physical, your world is premiums, availability, and time. Your risk is less about intraday price and more about paying too much premium in a frenzy, or letting the screen price hijack your long-term plan. If you are trading paper, your risk is survival. You can be right long-term and still be liquidated short-term. In loop regimes, position size is the most important indicator of intelligence. The smartest participant is often the one who isn't forced to do anything today. A lot of people get trapped by the idea that retail demand equals guaranteed higher prices. Not automatically. Retail demand can be strong while paper flows push the quoted price around violently. It is completely possible to have physical tightness while paper liquidation creates a sharp drop. That disconnect is not proof of anything mystical. It's what happens when the price is discovered in a paper arena and physical responds with premiums and availability. If you don't understand that split-brain reality, you will keep getting surprised. Most coverage will reduce this to a neat, comforting headline. Silver is down, so the trade is over. Or the opposite. Silver is down, so it's a bargain. Both versions are emotional shortcuts. They skip the part that actually decides outcomes, structure. Silver can be cheap and still fall. Silver can be expensive and still rip. In this market, the path matters as much as the destination, because the path determines who gets forced out along the way. And forced behavior is what makes the swings feel unfair. So what would retail fueling a new loop look like in real time? It would look like persistent physical demand that keeps premiums elevated, combined with heightened social attention that pulls more speculators into leveraged products. It would look like faster swings, more intraday reversals, and more air pockets. It would look like more talk about margin changes and platform restrictions. It would look like a market where both sides feel hunted, longs get flushed, shorts get squeezed, and the only consistent winner is patience. This is why the most robust strategy in loop environments is not prediction, it is durability. Durability means you size positions so that a violent candle does not turn you into a hostage. Durability means you accept that silver can overshoot in both directions. Durability means you plan for volatility instead of being surprised by it. And durability means you separate your time horizon from the crowd's time horizon. The crowd trades urgency. Durability trades patience. Silver punishes urgency like it's a hobby. If you want a simple scenario tree, here it is. One lane is continued chop, wide ranges, violent reversals, both sides getting trapped. Another lane is a liquidation flush, a sharp drop that clears leverage, followed by a calmer base. A third lane is a squeeze, a fast upside move driven by forced covering and momentum. The tape can move between lanes quickly, and that's why certainty is expensive. Instead of trying to call a single outcome, watch the signals, follow through, rebound quality, volatility trend, liquidity fingerprints, and physical premiums. One more detail most people miss: volatility transfers ownership. It takes positions from the impatient and hands them to the patient. It doesn't feel fair, but it is consistent. When the loop is active, the market is constantly testing who will blink. That's why emotional traders feel like the tape is against them. The tape isn't against you, it's simply harvesting fragility. The antidote is to stop being harvestable. Here's a practical routine. Once per day, check 5 things. 1. Did silver's daily range expand or contract? 2. Did the market close near its highs or lows or in the middle? 3. Did rebounds hold or fail quickly? 4. Did physical premiums change materially? 5. Did you see any signs of tighter leverage conditions or wider spreads? You don't need insider information, you need consistent observation. Patterns reveal regime shifts before headlines do. Now let's address the question everyone really wants answered. Is retail done if price is under 80? No. Price alone does not tell you whether retail interest is fading. Retail interest shows up in behavior, search trends, dealer traffic, premium behavior, and the speed at which dips attract buyers. A market can trade lower while interest remains. It can also trade higher while interest fades. The chart is the outcome. The inputs are the story, the flow, and the constraints. And if you're looking for a clean rule that survives most market regimes, it's this. Don't let your position size turn you into an emotional hostage. If a move can ruin your sleep, you're oversized. Reduce it. You will make better decisions, you will stop chasing, and you will stop offering your account as a donation to the volatility loop. Silver is not a moral test, it is a structural test. Zoom out with me for a second. Silver under 80, after wild swings, is a sign that the tape is still trying to decide who owns the market. It's the kind of zone where late buyers feel regret, late shorts feel brave, and patient money watches for mistakes. This is where the market can do its favorite trick. It can fake a breakdown to flush weak longs, then reverse to trap shorts, then chop until everyone's confidence is exhausted. And that exhaustion is often the setup for the next real move. Silver is a microphone pointed at a speaker. A little noise turns into feedback, and the feedback becomes the event. When attention rises, the feedback loop gets louder. People start treating every candle like a signal. That's when you get overtrading. That's when you get leverage creeping in. That's when you get the "I can't miss this" energy that makes the market dangerous. Because the market loves "I can't miss this." That's the exact mindset that creates forced behavior later. This is where people get tripped up. They confuse volatility with information. Not all volatility is information. Some volatility is simply the system clearing crowded positioning. Some volatility is collateral calls. Some volatility is market makers stepping back. Some volatility is liquidity thinning. In silver, volatility often tells you more about positioning than about fundamentals. That's why you can see silver swing violently, even when the physical story changes slowly. Physical is stubborn. Paper is fast. Paper dominates the short-term quote. Physical dominates the long-term constraints. In between, you get chaos. Let's make it practical. If you suspect retail flow is fueling a new loop, watch the physical premiums on days when spot drops hard. If spot falls and premiums don't budge, that's a signal that physical demand is resilient, or that dealers don't trust the paper price enough to reprice quickly. If spot rises and premiums explode, that's a signal that retail urgency is rising faster than supply can respond. Both scenarios can feed attention, which can feed the loop. Now keep this in mind because it matters. The word shortage gets abused. The wholesale market can be fine, while retail products feel scarce. That scarcity can come from fabrication capacity, logistics bottlenecks, dealer risk management, and the simple fact that during chaos, spreads widen. So if you hear retail is running out, don't swallow it whole. Ask, is it a metal shortage, a product shortage, or a risk management shortage? The effect on premiums and behavior can be similar even if the underlying cause is different. And here's the part nobody wants to hear until it's too late. The volatility loop doesn't care whether you're a believer. It only cares whether you're positioned to survive. You can be right about silver's long-term story and still get blown out if you are fragile in the short term. You can also be skeptical and still get trapped if you short into a squeeze with tight liquidity. The loop punishes certainty. It rewards flexibility and patience. That's why you have to treat this as a regime question, not a prediction contest. Silver under 80 can absolutely be the beginning of a base. It can also be the middle of a flush. It can also be a trap. That's why the most important thing is not your opinion. It's your process. Do you have a plan for volatility? Do you know what would make you wrong? Do you know how much pain you can tolerate without being forced? If you don't, the market will make that decision for you, and you will not like how it decides. So here's what I'm watching next in plain English. I'm watching whether down days get follow through, or whether selling exhausts quickly. I'm watching whether rebounds hold for full sessions, or whether they get sold fast. I'm watching whether daily ranges are expanding or compressing. I'm watching whether physical premiums stay firm during dips. I'm watching whether leverage conditions tighten, margins, platform restrictions, widening spreads. Those are the dials that tell you whether the loop is tightening or loosening. If the loop is tightening, expect more headline-driven swings. Expect more false breaks. Expect more sudden reversals. Expect more people declaring victory after a green day and doom after a red day. And if the loop is loosening, expect the market to get quieter. Ranges compress, follow-through improves, and price starts behaving like it's being owned by patient money rather than emotional money. Before we wrap, I want to ask you one question because it's the cleanest way to gauge what people are feeling. If you had to choose the next dominant move in silver from here, would you bet on a squeeze or a flush? One word in the comments. Squeeze or flush. Then tell me why in plain English, because I want to see whether people are thinking in slogans or in structure. Now let's bring it home. Is retail flow fueling a new volatility loop in silver under 80? It can be if retail attention is pulling paper leverage into the story and making the market fragile. The loop is not just price moves. The loop is feedback, attention, positioning, margin, forced trades, and thinner liquidity. Watch the behavior, not the slogans. Watch rebound quality, follow through volatility trend, liquidity fingerprints, leverage tightening, and physical premiums. And whatever you do, don't let your position size turn you into an emotional hostage. If a move can ruin your sleep, you're oversized. Reduce it. You'll think clearer. You'll stop chasing. And you'll stop offering yourself to the loop. If you got value out of this, subscribe. It's free. It helps the channel survive, and it helps me keep pushing back on lazy narratives with the actual mechanics. And send this to one person who thinks volatility is just noise. Not to dunk on them. To save them from becoming the next forced seller. Educational only. Not financial advice. I don't know your situation. Nothing here is a recommendation to buy or sell anything. Manage your risk, make your own decisions, and stay unforced. Stay patient. Respect the range. Size it so you can breathe. Don't chase candles. Don't worship round numbers. Watch the plumbing, not the noise. Let the tape prove it. Volatility is a cost, not a personality. Survival beats certainty every time.